everyone. Welcome in to the weekend edition of the KE Report. Corey Fleck here, hosting this whole weekend show from Beaver Creek, Colorado at the Precious Metals Summit conference that Chad and I have been attending all week, meeting one-to-one with companies. It's a great conference to catch up with companies, catch up with everybody else in the sector that we know, but especially on the company front, because you get to talk so much to these companies. And you also get a feeling and an understanding of what the overall mood is and what stocks are doing the best. It's something that we're really going to try to convey on this weekend show. It's one conversation with our good friend Dave Erfle. Dave, we're sitting outside in Beaver Creek. We've just wrapped up our meetings for Thursday. Thursday was a good day on the market. The mood was better at the conference, but when the conference started, the mood was maybe a bit somber for how well gold was doing, how well metals are doing broadly, but that's also because it seems like very much a bifurcated market, something that we'll also talk about. So, Dave, first and foremost, give us your recap of this conference. What's your maybe key takeaway?
The key takeaway is I've been coming to this conference for like 8 or 9 years straight, and I've never seen a more subdued conference. It's like people were accepting of what the situation is. And like you said, we've got kind of like got a bifurcated sector where you've got the haves and the have-nots. And a lot of people that I talked to didn't have full schedules. There was less people here, but everybody was upbeat. There's no depression, unless of course you're an early stage junior and you need money. But yeah, I mean, it's still positive. It's still upbeat, just less people and just a bit subdued.
What I was hearing too is there is a lot of money being offered to the right companies. So there is money out here. We had a stat a couple weekends ago that actually showed just how much money has been raised in the mining sector, which I think is mind-boggling to some people because of the lack of liquidity in the junior stocks. But let's talk about really the main theme here. When I went to, I think I had about 30 meetings, and there are very clear good companies and very clear companies that are going to continue to struggle. However, share prices are also telling us this. So how do you navigate those waters?
Yeah, it's difficult. You can, like we were talking off mic, like you could tell the winners. I mean, you could tell which companies that you should be backing. You could tell the ones that are going to be successful. And
the market's been telling us.
And the market's been telling us also. Like these companies have already gone up 3, 4, 5 times. So you have to say to yourself, okay, I got to pick my battles on when I'm going to get into this. But I've been trained not to chase a stock in this sector until the sector itself breaks out. So since we still have a bifurcated market, only the good stocks have been getting love. It's difficult. So it's basically, if you want to get really good value, you have to pick among the stocks that haven't moved yet, but talk to the management teams and find out if they have the catalyst to move, if they got their ducks in a row. They've raised the money. If they've got an economic study coming out that they feel is going to wow the market, and it'll be positive, and it'll be taken positive by the market, and they'll move the stock up. So you basically have to do your due diligence and talk to these companies and find out which ones that are still not getting any love yet that are about to.
But why not just ride the ones that are winning? They've been winning now for 3 months at least, some longer than that. They're still in uptrend, so why not take the easy road and play those?
Well, because a lot of the upside might not be there anymore. There's more upside in the more depressed companies that have yet to do well, but you feel will do well if they meet certain goals and put out certain economic studies that are going to be loved by the market. As far as drill plays are concerned, the drill results still aren't getting any love. I continue to shy away from those, but you're right. I mean, I hold several of those companies that have already moved. Fortunate enough, my subscribers and I have gotten into those early, but I also hold some of them that have yet to move and are down 20, 30, 40%. So then you have to say to yourself, okay, the market's starting to move. Do I sell these and get into something that's already moved? Or, if you do that.
What if those have catalysts, though? What if the ones that have moved still have catalysts?
Then yes, absolutely. You just wait for some weakness and you buy it. But it's still a stock picker's market. I think it's going to remain a stock picker's market until a few things happen in the sector. One, the stock market needs to roll over. We need to get that generalist capital in the sector. Two, I think the gold price needs to get above that inflation-adjusted high, which is around $2,700 an ounce. And, we've already seen margins increase considerably in these miners. 2 consecutive quarters of blowout quarters for these miners. Generalist funds can't ignore this sector for too much longer, especially if the stock market starts to roll over, and then they got to start looking for the next thing that's going up.
Hey, some of the generalist funds are in the sector, though. We talked last weekend about how overweight some of these funds are, too. But there's still room, obviously, to grow on that. Okay, if you see value in or the opportunities in these ones that haven't moved, that's 80+% of the sector. So let's talk about the more advanced ones that haven't moved, ones with resources. There's a lot of companies with resources out there. How do you differentiate between the ones that aren't going to grow those resources, but they're trying to move them forward? What stands out to you in that individual case of stock?
Well, the first thing you have to do is you have to identify the reason why they haven't moved yet. And then you talk to the companies, and are they working on that reason? And do they have a clear strategy to solve that problem? And if they do, if they have a credible strategy to solve that problem, and you feel that it's on the horizon, then it makes good sense to put a starter position into something like that.
What are some of these reasons? Give me examples of some reasons that you come across.
Well, the biggest reason, I think, is access to capital, a strategic partner. You've got a lot of these...
Yeah, because their market caps are tiny compared to what the build cost.
Exactly. So they have to do something with their project to make it stand out, to attract that strategic partner.
Okay. How do they do that? What are the right answers?
Well, if they're drilling out a resource, maybe they find a high grade core to a resource that is lower grade, and it's a game changer for the project. Or maybe something happens in the jurisdiction where they're operating. Something positive happens as far as permitting or as far as taxes are concerned. Or like what just happened in Argentina. They're lowering the tax rate from 35 to 25% to attract more capital into Argentina. So something like that.
Okay, that's a tough one, though, because that's out of the company's hands.
Right.
What about these, assets that have been around for a while, right? They're here. We know that they are here. Do you have any interest in them? You can call them optionality plays, but some of them do look like they have value, and then we hear from everybody, let's use the current metals prices. Look at how much better our PEA or PFS gets. But that doesn't move the needle for an acquirer.
No.
So what does in those cases?
It doesn't. Yeah, it doesn't. I mean, it's that access to capital is the huge one. They need the money to build to build the project.
Yeah, but that capital just isn't out there. That's the scary thing about all this, right?
Right.
Is that
exactly
that capital isn't there to build all these assets. And do we then have enough assets in the development pipeline now, in your eyes, that maybe some of these assets will just maintain on the sidelines so they're not attractive?
I think that these majors and these mid-tiers are going to have to come into them eventually, because they got to replace ounces, and they see the upside in the ounces as far as the gold price is concerned, and as far as their economic studies are concerned. If they did an economic study at a gold price base case of less than $2,000 and the gold price is rising above $2,500, $2,600, $2,700 an ounce, then that looks pretty good. But yeah, it's really difficult to raise money. It's really difficult to find that strategic partner that's going to go ahead and give you the 9.9% or even just the 5% to legitimize your project, right? So, not all financings are created equal. If you get all your financing from private equity, if it's just hedge funds, they're going to turn around and sell the stock in 4 months and strip the warrant. But if you got a strategic partner that comes in, that's strong hands, and they do a deal for more money in the future, that you've got that, and the street knows that you've got that access to capital. Because let's face it, Corey, we've talked about this before, we're still just trading amongst ourselves.
Yep.
There's no dumb money out there that's going to bail us out if a company does something that looks good to the market, but the street knows better.
Yeah. So what about those companies that have a strategic in already, 5, 10%, what have you, but they've been in for a couple of years, maybe even 5 years? How do you discount that?
Yeah, especially if they've got more than one. The market's already done that, and they probably moved up the stock pretty nicely. And the one thing we haven't really mentioned is the dilution factor, right? So you've got a company that's de-risked to the finance stage, the permit stage, what have you. They still haven't attracted that partner, and their share price is still, wallowing in the lows, and they're running out of cash, and they're going to have to go to the private equity market since they can't find a strategic partner. They're going to have to try to do something, something totally different, to try to have to maybe sell a royalty, or we've seen a lot of companies do that, and that really hasn't worked. They get a little pop, and then they just keep selling off after that. So
yeah, because that's short-term capital.
It's
the
short,
problem is
exactly.
It doesn't build the mine.
It's short-term
right?
capital, and it also puts constraints on a project that makes the project less attractive to a major. If you're lucky enough to come to a point where you've de-risked it to where maybe somebody will take it out, and then they're going to look at it and say, "Wow, well, you sold this royalty." So yeah, it's very treacherous. It's very tough, but it's still very attractive because all you need is, let's say you accumulate a basket of 10 stocks. All you need is one or two of those stocks to be multi-baggers. And let's say you end up having to sell the other ones at a small loss or maybe just a small gain, then you're doing really well.
Yeah, I still think this is the market, though. If you just stick to the good ones, then a lot of them can be winners. Like, it'll be
Absolutely
the minority that are losers.
Right.
So that's the easier
You just
game.
have to change your strategy, right? Like
Yeah.
my strategy when I started my newsletter in April of 2017 was, and it still is to a certain extent, I don't touch anything unless it has at least 3 times upside. Well, some of the companies that I accumulated that I had that mindset, they've diluted themselves out to where I'm lucky if I get 3 times upside, right? And I consider a failed investment anything that I have to sell that didn't make me 3 times my money.
Okay. I still think this is a good market, though, where you can just make 2 times in a number
Right.
of stocks and have some maybe safety protection because they are the better stocks.
Right.
But look, these guys that need to get creative with financings, I think those are avoids in general. Like that's too difficult to even time or know when it's going to happen. What about exploration plays then? I know you've largely avoided those. What about more the exploration plays that have assets, but they're exploring, so they're looking for something else? How do you discount them?
Yeah, anything that's early stage, it's got to be a PEA stage company for me to look at it. But it's always a bonus if you have a company that's de-risking an asset to the feasibility stage, but they also have another project that they're drilling, or they're bringing in more drilling to the feasibility besides infill and making it bigger at the same time. So there's these things that you look at, and of course, single asset anything has gotten a lot of negativity because of what's happening to some of these single asset companies. Like first we had Victoria Gold with the heap leach snafu, and then it went into receivership last week, and then on the heels of that you had Ascot having to shut down their mine just 5 months after pouring first gold and have to raise even more money, and then saying in their press release hinting that they might not even be able to raise more money. So it's very treacherous out there. So even the companies that are starting to produce and you think they're going to get a re-rate, something like this happens to Ascot, the market's going to be tentative.
Yeah, fair enough. It seemed like Ascot was having trouble, though.
Oh,
you could
absolutely.
tell
They
by
kept
the
having to
news.
raise money.
Yeah.
I mean, how would you like to be one of the guys that participated in the 34 million bought deal finance in July?
Yeah.
Right?
Yeah.
Your shares are on hold. You got in at 43 cents. And then just a few months later, they shut down the mine, and you're sitting there holding the shares that you can't sell, and you watch it fishing line down to 16 cents, and you can't sell your stock until late November. Ascot might be in receivership by then.
Yeah.
You might lose all your money within 4 months in a private placement. I think there's going to be some lawsuits over this one.
Maybe. We'll see. Those are never good for the sector.
No.
But there are success stories out there. So, okay, exploration, largely avoid right now. Development style plays, you like those. Is there a certain market cap that you feel like the market, if you're, say, sub 20 million, sub 30 million market cap, that the market's just ignoring?
Yeah. I hate to harp on this, especially you see that, let's say they got that 20, 30 million market cap. They've proved up 4, 5, 6 million ounces.
Yeah, the market's telling you something.
And the
about
market's
that, right?
telling you something about that, exactly. But what's the reason why it's not moved? What's the reason why a strategic partner has come in? It could be permitting. This thing's not going to be shovel ready for 3-4 years. You're a 20, 30 million market cap company, and you're not going to be shovel ready for 3 or 4 more years.
And how do you raise, right?
Exactly. How do you raise?
No mine costs $20 million to build. Well, very few, and they're not big enough.
Right.
Then.
No one's going to give you a debt structure without any cash flow.
Yeah. So there is a market. Stay away from market caps, maybe sub 20, sub 30. Maybe the special situation would draw you in, but the market's telling us this, right?
Exactly.
The market is telling us the higher
It's 20 or 30
ones.
million market cap, even though they have 4 or 5 million ounces for a reason.
Yeah. Okay. Then producers. Producers are making money. Gold
Producers are making money.
Across the board are making money. Silver producers are starting to turn a profit, but that's still clearly not got the excitement. So, gold producers, what do you look for?
Well, I mean, you look for high margins, right? If it's a gold producer, you make sure they have enough cash in the bank to cushion something bad that might happen that Victoria did not do.
What's enough cash in the bank, though? Because some of these guys are just starting to
build
up balance sheets.
30-40 million bucks, and maybe a debt facility that's untapped, but that you have set up just in case you need it. But it's especially if it's single asset. But is it a single asset producer with a mine that's really attractive and it's got blue sky potential, and there could be multi-million ounces there, even though they've only proved up a couple million, they're mining them, but there is blue sky potential there, that they proved up a proof of concept where to try to attract a major that said, hey, we need to be acquired.
Well, also, that's been a better model for the sector, right? Don't just keep going back to the market.
Exactly.
Actually start up a mine and generate some cash flow.
Exactly.
And then show the blue sky.
Right.
So is there too small of a production profile for you, or?
Oh yeah, absolutely. I mean, if it's less than 100,000 ounces, and you don't see the blue sky there, then yeah, I mean, absolutely. But do they have other assets? I mean, they just got this producing asset to have some cash flow because they've got some other assets that they're de-risking, and now they've got the optionality of the gold price in production. Maybe they're producing some free cash flow to cover their expenses on what they're de-risking elsewhere.
So this is all very precious metals focused, right? Clearly this is a precious metals summit, but there are different companies here that are exploring for other commodities, other metals. They don't seem to be getting the love, though, do they? This is a precious metals market right now.
Absolutely, yeah. I mean, copper, it's a good time to look at copper plays because people hate them.
What kind of copper plays, then?
Well, not early stage. Not early stage.
No, early stage isn't working anywhere.
But if you're looking at late stage, you really have to look at permitting. I mean, how far out are they going to get these permits? And is the land that they're on, is it private land? Is it federal land? If it's private land, you're probably going to get the permits a lot quicker.
Okay. Are there any copper companies, any other metals that stand out to you in terms of companies that you are building positions in then?
Yeah, there is. I mean, I could give you one that is my favorite copper play is Arizona Sonora. My subscribers and I have been in that for a little over a year or so. And they've got a strategic partner. They just put out a fantastic economic study. I don't think they're going to have to raise money again because they got this really strong strategic partner they did a JV with. They're on private land. They're fast-tracking the project. And they've got something called a Newton technology that if it works, it's going to really upsize the project.
Yep. We've had them on the show a number of times. It's a big asset in a good jurisdiction. But again, this all circles back to just keep it simple. Don't chase anything in terms of bottom fish, though. These stocks that are okay, that have a market cap, that might not be completely washed out, I guess stick to them.
Yeah, well, if you're going to bottom fish, you really got to do your due diligence. You got to sharpen your pencil and really ask the tough questions of management team. Look them in the eye when you get your answers because there is huge upside if you bottom fish in the right companies, but it's a tough sell.
Well, looking management in the eye, what you hear in almost every meeting you're in is we're meeting with a lot of corporates. That is what this conference is to a lot of corporates, a lot of tire kicking, but it's what we hear every year here.
Yeah.
So how do you discount that? Because, look, a lot of projects, the vast majority of projects need funding, right?
Right.
And everyone says they're talking to corporates. Everyone's got some package that they have in mind.
Right.
But when does it actually resonate? It's simply on the back of news?
Right. Is it on the back of news? Is it a gold price? Does a gold price need to get to a certain level?
Yeah, that's the question. But that's what you
do they
hear
have to
from
de-risk
everybody.
to a certain point? Do they have to get a permit or whatever? I mean, it's very difficult, but I like challenges. I like challenges, and that's why I love this sector, especially in a bear market. You know, because it's a really, really big challenge. But if you get it right, it feels really good because it's a needle in a haystack as far as mining is concerned. Most of them fail.
Yeah, they do, but you can make money even in the ones that fail,
right?
Especially if we are truly in this bull market run where everything's going to go higher. But again, portfolio-wise, do you have a bigger portfolio now, or are you much more narrow? I know you, with your subscribers, share your top 10 lists, which is narrow in itself, but are you expanding your portfolio?
Not at the moment. I expanded a little earlier this year, but no, not at the moment.
Okay.
I'm happy with what I have.
Yeah, I've seen you trim some positions here and there too.
Right.
Just
built
to
up a little
rejigger.
cash.
Yeah.
To add to some other ones that I really like that I'm still accumulating.
Mm-hmm. Man, this is just the market, though, isn't it? It's selective.
It
but
is.
there are good companies, and the metals price is doing its job. So,
and if you've been around long enough, you know the teams that you can trust to back, right?
But again,
and you know the ones to stay away from too.
They're re-rated, though.
Right. Most of them are, unless they've started a new company recently.
Yeah.
Right. And they got a strong board, and they got a tight share structure, and they just raised a bunch of money, and they got that access to capital. And
Yeah, it's actually a pretty simple playbook. Though,
it is,
isn't it? Like, just focus on the ones
it
that
could
are
be.
that
It
are
could be
simple.
really difficult if you get overwhelmed by the whole thing. But if you sit down and concentrate on the right things you need to concentrate on.
Yeah. You meet with any Australian listed companies here?
No, I don't invest in Australian companies because most of my subscribers are U.S. based, and they can't invest in Australian companies. So I pretty much stay North American, Canadian.
Okay. I had a couple meetings with some, and man, they carry some high valuations for ounces in the ground. I'm still impressed.
There's
As
a
much
lot of
as
Australians
that market,
here. Did you see that?
Yeah.
Notice that? Yeah.
Well, and as much as that Australian market has come off, it's still more richly valued than the U.S. market,
Absolutely.
which I guess is just
and they got
us.
these share structures that are just
completely
blown out.
Completely blown out.
Yeah.
But their share price is kind of hanging in there at cents, but it equates over to decent market caps, I find.
Yeah, absolutely.
But, hey, these guys have built mines, so they've built up that reputation. They have more interested investors.
Mm-hmm.
Anything else that caught your eye at this conference? Anything that you're coming away with that maybe sparked a little something in you?
In an atmosphere like this, I think it's easier to pick the winners. It's easier to know what to focus on. In a bull market, it's really easy to pick the wrong horse. Yeah. And in a bear market, it's really easy to pick the right horse. Mm-hmm. So I'm picking the right horses, I think. I'm going to pick a few wrong ones, but it's going to happen. We keep saying that. It's going to turn around at some point, but it
has turned around.
The
majors are doing great. The mid-tiers are doing just fine. It's trickling down. And remember, this really just started in March, at least the gold breakout.
And we're seeing once the gold price got above 2,500, that's when the M&A started heating up.
Yeah, but don't depend on M&A. It takes too long.
No, but
you can't bet on.
But I like big M&A because it draws more generalists into the sector, and what we need is a bidding war.
Yeah, we need some excitement.
Yeah,
some growth for growth's sake. I know it's not good in the end, but it brings in people. It brings in other investors.
We might have an opportunity for a bidding war. Anglo Gold just offered to take out sentiment for 1.9 billion pounds. Yeah. And if you'll recall, Endeavor attempted to take out sentiment in December of 2019 for 1.47 billion pounds. But the gold price back then was about $1,500.
Yeah.
So the gold price now is $1,000 more. Is at 65% more, $1,000 more. So the margins at that huge mine in Egypt that Sentiment has, Sukari, right? So those margins are huge right now. So I wouldn't be surprised if Endeavor might make another swipe at it and try to maybe make a better bid.
Hey, that'd be nice. Well, and that brings up this other concept too, and it's what we hear in every meeting. Somebody that has a PEA or some economics, look at the sensitivity. You brought it up earlier, and look, everything looks better at 2,500 gold, no matter where you did your economics before. But that's everybody. So do you run the numbers at, say, 2,200 and then compare these PEAs, or do you kind of ignore these guys and say, look, this is sector-wide?
I mean, you have to compare the PEAs, because it's not just about the gold price. Yeah. There's so many variables. What's the payback period? What's the CapEx? What's the sustaining CapEx? What's the mine life? What's the discount? If they're still using 5% discount rate, I mean, come on. That's a fantasy. That's never going to happen again.
I know, but for comparison purposes, right? So that's why when you do hear these guys say, oh, at the current metals price, our IRR goes to this, do you then look at your other holdings and say, okay, what does their IRR go to at this price?
Sure.
Yeah?
Yeah, absolutely. Yeah. I mean, not everything's right. We haven't had a bull market in the entire sector yet. We've just had a bull market in specific stocks.
Yep. Yeah, but they're growing. There's more and more of them that are joining in.
There is.
It's encouraging, right?
It is.
As interesting as this conference was, where there are less people here this year.
Oh, yeah.
Compared to last year. And it's a better market.
Right.
There are clearly some companies that are very happy and very busy. And again, what I'm hearing is there's money available. But I'm also hearing from some companies that they need to raise and they're worried.
Yeah,
that is
because maybe they know their
crazy.
project is not solid. Maybe they know they're a lifestyle company.
Yeah. Well, and the market, again, is telling us this. I think.
The market is telling you you're a
Look
lifestyle
at the share
company.
price. The market is telling you what is higher quality.
And in a way, Corey, this is all a good thing because remember, in past pendulum swings from bear market to bull market, once the finance window opened, everything got financed.
Yeah.
Right? When money was cheap, everything got financed. Money's not cheap anymore. Banks are being selective. Equity investors are being more selective so that the shit isn't getting financed anymore, which is a good thing.
Yep.
A lot of these companies need to go away.
Yep.
Many of them need to merge, and many more of them need to go away. We always say, well, this time it's going to happen. Well, these companies are going to go away.
No.
And they end up getting the lights on raised somehow.
Yeah, they survive.
Stick around.
Mm-hmm. And they probably will here again.
Yeah.
But it is interesting. As much money has been raised, and there's been a lot raised, it's much more selective.
Right.
Which is fine. Look, this is a bull market. I don't usually say that kind of stuff, but this is a bull market. But it's just selective. And quite frankly, all the other times when financing windows opened up, it was a 6 to 8 month run, and that was it. And then it just rolled back over.
Well, look at the past 8 years, right? We've had 2 6-month bull markets followed by 2 4-year bear markets.
Yeah. Yeah, maybe that's what we're waiting for. That same degree of bull market behavior, and then it
bull market
the top.
mentality. But if you take a look at the volume on the GDX and GDXJ, it's half of what it was after the COVID spike.
Yeah, keeps declining.
Yeah.
Oh, yeah, we've talked about that a number of times.
Yeah.
I hear you. Dave, man, great seeing you at the conference. Always enjoyable being here. We'll be back at it next week. Full slate of interviews and bringing on some new companies that we met with. Everyone, thanks for tuning in to this weekend show. Send me any emails that you have, fleck@kereport.com. I love hearing from each and every one of you. Dave, let's take it off from here.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.